All right, welcome everybody. We're gonna give it a few more minutes for everybody to join in, then we'll get started.
We here in Stone Mountain, Georgia, doing due diligence on our most recent acquisition. And this is a process that we do with every single property that we take under contract. Before we're able to present these properties to our investors, we come into the property and comb through every single aspect of the property to make sure that it's still a solid investment and the risks are low going into the assets. We also come in to identify areas of opportunity with this particular asset. So what we've been doing here in Georgia since we got here yesterday is we've inspected all the buildings, the physical structure, making sure that everything is solid, no foundation damage or no major drainage issues with the property. We've looked at the roofs, we've looked at the sidings, we've identified all the cosmetic fixes that need to be done. We had our contractors here looking at every aspect, coming up with quotes so that our underwriting is in line with whatever we expect when we take over the management of the property. Another very important piece that we do as part of the due diligence is we shop around comps, look at other properties in the same market to see that if the rents we are projecting are achievable in this market. And for this particular property, we're really excited because we found some gems in the area and the numbers look really exciting going into the property. And today we're doing unit inspections, inspecting every single unit on the property to make sure that we don't see any major damages, no surprises. And sometimes in this due diligence, you could come across some interesting cases. But so far, everything looks great. Most of what we're seeing is cosmetic. So we're excited about this opportunity. And we're excited to take this one and under the ownership of our investors as well. Another piece of the due diligence we do is a financial audit. We go through all the leases, look at all the lease terms to make sure that everything that has been represented by the seller of this asset is accurate according to what we see on the asset. So we have our team currently looking at every single lease, looking at all the fees that every tenant pays to see if there are any areas of opportunity or if anything is below market or anything is at market. So we do all of that, put all of that information together, and we factor that into our business plan as we take over the property. This is the key important part of the acquisition process to make sure that whatever asset we're presenting to our investors is a solid opportunity with very low risk and high opportunity for reward. And we're very happy because this one, I gotta say, our partner, Mr. Senator, did an amazing job in finding this gem. So we can't wait to present this one to the investors, and the due diligence is going really well.
All right.
Why do some people do so well in life?
Sorry.
While so many.
My YouTube there keeps going with Earl Nightingale, whom I love listening to. But welcome everybody, and welcome to this presentation by XSITE Capital. So the goal of our presentation tonight, we're just going to be reviewing the numbers of the deal. Again, do not take, first off, this is presented for information purposes only. Do not take my word for it. This is an opportunity for you guys to challenge some of our assumptions, to ask whatever questions that you have about our assumptions and the underwriting. So today, the way this is going to go is I'm going to be sharing my screen and showing you guys our underwriting template, some of the numbers that we have. For this asset, like in all of our other assets, we have been very conservative as we're projecting the growth, built in a lot of cushions on the asset just to show that any changes that might happen in our business plan or in the economic cycle that we're in. So I'm going to be showing you guys the underwriting template, and I'm also going to be showing you guys some of the resources that we use to come up with some of the assumptions that we make when we go into these properties. One of those resources is RealPage, which is like a great data source that aggregates data from markets and other properties, and is able to tell you how properties will perform. And we found that that data source, it's somewhat accurate. So we use it a lot. And I'm also going to be showing you some comps in the area, just to show you the kind of opportunity that sits on this asset. Needless to say, we are really excited about this asset. We are really excited about this opportunity, and we can't wait to get in and start doing the work and make this another successful acquisition for our investors.
And if you do have any questions, please do not hesitate to just drop it in the chat. We're going to make this a really fun session where, Leslie's going to be sharing you all the numbers, and if you guys have questions, we'll make it a little more interactive. So we hope you enjoy it and have fun.
All right, everybody. So to start off, Mountain Vista is 144 units property. We're buying this in Stone Mountain, Georgia, right outside of downtown Atlanta. And so we're buying this at $124,000 per door. That's 144 units. And which we're getting it at a cost basis quite below market compared to some of the comps that have sold in that market recently. And one of the reasons why we're able to get this asset below market and with this much opportunity for growth available to it is because of our previous relationship with this seller. This is the same seller that sold us the View at St. Andrews. That's a property that we're currently exiting from right now after 20 months of ownership. We bought that in April 2021 at $12.55 million, and we're selling it today for $17.8 million. And he has a reputation of identifying markets way ahead of time, markets that have opportunity for future growth, and just buying assets and holding on to them. He's an owner that we love buying from, and we hope to keep buying more assets from. And this one comes with a ton of meat on the bone. And I'm going to kind of show you some of that, which really got us excited when we started digging into the numbers. And so just looking off the cuff of the property, currently right now, the owners are running the property at a T3 expense rate of 49%. We going in at year one, we're estimating our expenses are going to go up significantly to about 64.59%. So again, building in, not going low. As you can see, the current owners are not spending anything on marketing, barely spending anything on some of the contract services as well. So we're building in all of that into our projection, into our underwriting, saying we're going to be spending this much money upfront because we want to run an efficient property as well. And so we're going in with about 26% loss to lease. That is the gap between where the new leases that have been getting signed over the last 3 months are, and where the other ones are. So there's a huge delta there to increase to increase the rent organically, right? And most of those leases are expiring over the next 12 months. And there's an opportunity to capture that growth in rent. And we are being very, very conservative in how we are projecting capturing that delta in income, which is about $605,000. Current vacancy in this property is 2.84. This market is like, that's one of the things we learned when we did our due diligence in this market, and I kind of alluded to on the video. This market is like, it's hot for rentals. Even some of the property managers cannot really understand why there's such an increased demand, but they've seen a tremendous increase in demand over the last 6 months. Most of the properties have a wait list. That is, they are 100% pre-leased. Vacancy is very low, and the rents like keep increasing on a day-by-day basis in Stone Mountain. And I think part of the reason is because even with the increased rents that is happening in this market, the market is still below what most other submarkets in the Atlanta area are renting for. So it presents itself as a great area that is not too far away from downtown Atlanta. That could be an alternative for people that are looking to downsize and come into a building that is a little bit more affordable. And that's our business plan. We're going to position this asset as an ideal location for people that are looking to scale back a little bit, come in and have a beautiful place to stay in a nice, safe environment. So we have our expenses on there. We're going up significantly on the expense. The taxes, again, I'm going to talk about the taxes as well. This just goes about the different unit mixes we have. As you guys can see, we have a ton of majority are 3 and 2 bedrooms, which bodes well because the rents are much higher in the 2 and 3 bedrooms. The market rent on the property right now is $11.45 for 1 bedrooms, 13.25 for 2, and $14.95 for 3 bedrooms. Now, this is what the property is currently charging for new tenants that are coming in, and again, demand remains very, very, very high. I'm also going to talk here about our value add strategy. This is kind of like a detailed breakdown of what we're going to be doing to this property. This property was built in 1984. The exterior, or like the property, has not been touched at all. Even like the interior of the property, most of the units are classic units. So our goal is to go and spruce this property up. We're going to replace about 70% of the roofs in this property. We're going to repaint the whole property. As you can see, all of that, these are all prices that we've quoted. We actually had our meeting with our property management and construction management team today, and ironed out all of these details. And again, most of these numbers that we go into with a higher estimate, and just to have a lot of cushion in case we run into any surprises. We did dig through all the property. Most of the issues we identified with this property are related to the roof and like the sidings. And a lot of the maintenance costs actually on the property right now is related to that. We do anticipate a significant decrease in maintenance costs once all of that is completed. But as you can see now, as I'm going to show you now, underwriting, we did not factor that into it as well. We assume that the expenses are going to keep rising as the years go ahead. So we're going to be doing a lot of work, adding a robust security system to this property to keep it nice and safe. We're going to be changing, like they have like a nice, if you look at the pictures that we have, they have like a nice outdoor area that is dated. It used to be a tennis court. So we're going to build like an outdoor gym out there, clean up that area, open it up. So right from there, you could see the Stone Mountain, which is like one of the tourist attractions there in Georgia. We're going to clean up that area, make the property really appealing for the quality of tenants that we're looking for. We're going to enhance the pool area. We're going to do some interior renovations as well. As of right now, our business plan is budgeting renovating 52 units out of 144. That is less than 50% of that, and allowing the other units as meat on the bones for the next buyer. Going into the property, there's like a lot of appreciation, a lot of meat already on the bones that we can go in, take care of the exterior, all right, and then capture some of that rent delta that increases that exists in the market, and then start doing some unit turns. From that alone, we're able to meet the projections that we are projecting, the conservative projections that we're projecting on exit. And I'll feel free to drop you any questions that you have in the chat. On this tab, this just goes over like the business plan over the 5-year hold period that we're projecting. Year 1, year 2 rent growth, we're projecting 5% and 4%. In this submarket, RealPage is projecting 14% year 1 and about I think it's about 8% year 2, and 4% and 5% moving on from then on. So we are below what is being projected in the market as of right now. We projecting that our expenses are going to keep growing throughout the hold of the property by 4% for the first 2 years, and then 3% moving on forward. So as you can see, the loss to lease that I mentioned, there's a loss to lease of 26%. And aggressively, if we wanted to be aggressive with our numbers, we could have said we could burn this loss to lease down over the 1-year period with the lease terms, because every new lease on the property right now is getting upgraded to the new market rent. But we are saying that that is going to happen on a more slow basis, given a little bit of cushion for any surprises that may happening. So we're saying that year 2, we're still going to have a 10% loss to lease from today's numbers that exist. and year 3 is going to be 5%, and then we taper it off at 1%. So we're burning that off slowly over the 5-year hold period. And I want you to pay attention to the effective rent on this property right now. Over our hold period, year 1 is 1177, and we're saying that on exit, year 5 is going to be at 1549. The reason why I say you should pay attention to this is this is a number that you could go back and do some more research on yourself and see what the other properties in this market are currently renting for. Actually, our exit rents at 1549 average effective rent is what some properties in that area right now are currently renting for. And I'm going to show you one good example. So we're being very, very conservative on how we are projecting the growth of our income on this property, because we know these numbers. We are very, very confident that we're going to hit these numbers on the rent growth. On the taxes, the tax in Georgia, taxes are being assessed, I think it's every 3 years. And the new tax assessment was done on this property in 2022. And the owners, the current owners right now, have appealed that tax valuation. So the tax hearing is occurring on September 30th. That is on Friday, actually, the tax hearing is occurring. So if his appeal works, right, the taxes, the valuation, like the value of the property was placed at $18 million. He's appealing and saying that the property is valued much less than that. So if he's successful in appeal, this taxes that we've underwritten is going to go down significantly. It's going to go down by tens of thousands of dollars. That will significantly increase the cash flow. But we are assuming that, okay, nothing changes. The taxes that have been assessed to the property are going to stay during our hold. And so those are the taxes that we underwrote on this property. Taxes is one very, very key component that could surprise you as an operator if you're not getting like the right quote. So this one, we have that in, and we do expect that it's going to get better from the news that we get. The other piece I want you guys to pay attention to are the expenses. As you can see, the expenses keep increasing over our hold, even though we know that from the renovation, from the changing of the roofs, the updating of like we're going to do change the toilets, change all the plumbing, put in low flow energy efficient plumbing on there, change the lighting, put LED lightings outside to decrease the electric cost. So we're gonna make this property more efficient on an energy basis, and we're gonna make it more efficient, like less costly on the maintenance side. But we are not factoring all those changes, all those improvements into our projections. We are saying that those expenses are going to keep increasing based on the projections that we gave to you. We're saying that those expenses are going to keep increasing toward our hold. So now when we get in the property and we're able to implement all these changes and improve the property and improve all the expenses, all of that cash flow passes down to you. And some of you are are current investors in some of our other assets. You've seen that where we've projected 6% cash flow year 1, and then you end up getting 8% plus. So that's typically our approach when we go into these properties. So we will leave a lot of cushion on here so that any surprises that if we were to run into any surprises, all these expense increases that we have here is going to cushion us so we don't have to be stressed while running the property. And one other important piece is like the debt. I know everybody, the Fed keeps jumping numbers over with debt recently. So that's one of the concerns that a lot of people have right now. So for this property, we're going to be doing a bridge debt with a fixed rate cap that we're going to be buying from for the debt. And we already have an application and a rate locked in as soon as the application went in with Bancorp. We're using a local bank, like a small bank, for this loan. As you can see, this is the application here. We did underwrite. I'm just going to show you some of the terms here. So we did underwrite the entry rate, like the floor rate for the bridge debt at 4.25%, right? But this is, let me see here. Just gonna show you like what the interest rate is actually that that we got locked in on, and this just got sent in earlier on this week. So the floor basis interest rate that we got is 4.10, so slightly better than what we on the road, and we have priced in a rate cap to lock in the interest rate, to lock the SOFR curve not to float above 1 to 1.2% above where we are buying the property. And we have that rate cap incorporated into our underwriting as well. And that's the cost of about $1.2 million to lock in the rate over 3 years period of time for this property. We're not going to take any risk in saying that maybe the rates are going to keep dropping, going to start dropping down because the Fed have stopped. So we are going to lock the rate out over the first 3 years, that period of time where it gives us the opportunity to complete our value add over the first 24 months. And then we either start looking to exit or refinancing by year 3, so that into a more fixed and stable debt. And the projections that we gave to you guys was based on an refinance exit, which is exiting at like refinancing at year 3 and exiting at year 5. And exit refi interest rate is at 6%, which is very reasonable considering where the market is at right now. The other thing I want to point your attention to is like the going in cap rate. The going in cap rate for this property, T3, T12 cap rate is at 4.59. T12 cap rate is at 4.117. Market cap rate over the last 12 months in this area for value add multifamily, it's about 4.2 to 4.5, right? But we are saying that we're going to exit out of this property at 5.2 cap rate. That's about judging from like the 4.5, that's about 70 basis points higher than where we're going into. Typically, as you know, multifamily investing, saying that you're going to exit 10 basis points per year during the ownership of the property, like interest rates are going to increase 10 basis points per year. It's conservative enough to know that your exit cap rates are higher than your entry. But we felt like given the place that we are in the economic cycle, we should stretch that out a little bit. So our exit cap rate is projected at 5.2, and that is at year 5. And again, on our presentation, we had 2 business plans, like the primary, which is what is presented to you with an 18.5% average on our return, and the secondary, which is to exit in year 3. Our goal going in will be to renovate this property and exit out in year 3. But we've taken into consideration that the market might not be as strong as it has been over the past years, and then we'll need probably to refi and hold on to 5 years. So the presentation, the projections that we're giving to you is more of not the best case scenario of what could happen in this property. But if we were to renovate the property and over the 24 months, and the demand that we're seeing in Stone Mountain stays strong, and as is projected by like other data sources like RealPage, if it stays strong, then we'll be able to exit at year 3, and the returns are much, much better. And that is referenced in the presentation that we shared with you as well. Let me see. And I'm just going to show you our mortgage tab here. As you can see, everything is already, the SOFR curve is built into our underwriting. So from day one, like there's no moment where the interest rate even stays at that 4. So from day one, we hit our cap, like the cap that we're buying. So that is already factored into the underwriting, and it's factored into the cash flows as well. Again, I see some questions dropping in the chat, so keep dropping your questions in the chat. What else? So these are some of the things that we put in going into the underwriting. I'm going to switch gears right now and kind of show you like RealPage. I'm sure I hope everybody can see this. So RealPage is currently valuing this property at 24 million. And this valuation is based on like the average rents in that area and the average expenses in that area. And taking into consideration like the most recently reported numbers on that area, that is how RealPage comes up with its valuation. And it's valuing this property as of today at $24 million, We're buying this property at $17.86 million. As you can see, it's saying that the effective rent in this market, the average effective rent in this market, as of today, should be at $13.47. We're going in saying that we're going in year one and saying we're going to be at $11.77, and at year five we're going to be at $15.49, which is just about $200 away from where today's effective rent is. And occupancy 97.92%, which has stayed that high throughout over the last few months, and most of the other properties in this market are staying that high. You could see the income, the revenue projections that RealPitch is given for this property over a whole period. This is nothing. Our projections are nothing close to this, right? So we are significantly less aggressive when it comes to like income projections over that whole period. As you could see over here, right? Like our total effective gross revenue, right there, it never really hits the 3 million mark throughout our hold. But we have like a reliable data source analyzing what is based in the market and showing where this property could go if it's properly managed. Just gonna go down to some trends here. And it tracks trends to up to 1 year ahead. So the quarter, most of the trends are on the upswing, showing an increase in effective rent, not drastic, nothing drastic, just a progressive increase in effective rent, which is kind of in line with what we saw in this market when we were touring the market. And the other piece I would like to show you guys is one of the comps that we really like. The reason why we like this comp is because they're implementing exactly the same value add plan that we have for this property. This is our Willow Lake Apartments. It was built in 1971. It's in Stone Mountain, Georgia. It's about less than half a mile away from this property. And you could see where the rents are today, and you could see the unit sizes. For 850 square foot on a 1-bedroom, the rent is from $12.14 to $15.65. So their renovated units are closer to the $15.65 number. 2 bedrooms, $11.76 to $15.56. The renovated are more on the high side, and 3 bedrooms all the way to $18.06. Now, these are the rents as of today, right? And if you do go over to Stone Mountain, Georgia, and visit Willow Lake Apartments, these apartments have a wait list, right? So this is the comp that was referenced in the video, where when we taught this comp, like we were really able to see the strong opportunity for growth that exists with this particular property. But we are going in, being very cautious. We'll rather underpromise. We do believe if we're able to deliver 18.5% to our investor, those are great returns on an annual basis. Those are double-digit returns. But we shoot to deliver way more than that. So we're going in being extra conservative. But if you're investing in the deal, come in knowing that your returns that you expect are going to be somewhere around 18.5%. So that's kind of a synopsis of our underwriting, our thought process as we go and look at these assets. I just gave you like kind of a brief overview of some of the in-depth data and research that goes into everything that we do. You saw some of that in the video as well. We actually go into this property, we comb through every aspect of it. We identify any kind of issues that might come along our way, and we challenge our assumptions. And we hope that you too challenge some of our assumptions as well. Do as much research as you need to make sure that this is the right investment for your portfolio. But we are very confident about this asset going in. We are very confident about the possibilities that exist in this asset. So I'm seeing a good amount of questions here. So let me start. Increase in taxes is great for underwriting. Would the property be reassessed upon sale? No, in Georgia, taxes gets reassessed every 3 years. So it's not going to get reassessed upon sale. I think the next reassessment, this was done in 2022, is in 3 years from today. So refinance or sale must happen year 3 then? No, not necessarily. Our bridge debt is 3 + 1 + 1. So we could extend year 3 by 2 extra years, but our goal is to refi or sell at year 3. Those are two primary goals, and if that doesn't work, then we are going to increase like extend our bridge loan. How much operating reserves will you keep? That's a great question. So for the value add, we have 10% of the value add cost locked in as reserves. We usually do that for every, so that's the first reserve that we have. Then we also have an additional amount of reserves, which is underwritten right here in the property. We have about $267,000 in reserves left in the property. I'm loving the questions. This is some really good question. How far is the comp property from Mountain Vista, e.g. miles, same neighborhood? Yeah, it's the same neighborhood. It's about 0.5 miles away from Mountain Vista. The thing about Mountain Vista is there are not many apartments around this particular location. On the highway, that's Stone Lithonia Highway, coming into Mountain Vista. Let's say Mountain Vista is on your right. Prior to getting there, there's like a nice neighborhood of like $500,000 to $1 million homes right there. So it's more of a nicer residential area. Then about half a mile to a mile away, you go where you start seeing a bunch of different apartments in that area. So that area where I'm looking at Willow Lake, there's a concentration of other like C plus class apartments, and not too far away from that, you have some other D or C minus apartments. So the Mountain Vista area is much nicer. We just have to make sure that it's nicely secured and make it much more deserving of the neighborhood that is in, because right now the building has been neglected throughout the whole. So what analysis took place when you determined that you would only upgrade 52 units? So the decision-making process going into that is what kind of returns are we able to achieve for our investors going into renovating 52 units? So we're not going to go and renovate 100 or 220 units when we know going into the property, we are able to do less and still get the returns. Now, allowing more of a value add into the property, because when you're going into these properties, you gotta go in with the end in mind. You gotta think about the exit. So we're presenting an asset, presenting a story that will be great for anybody that wants to come over and take over the asset. Like as an operator or like as an investor, if you have the opportunity to buy an asset where you could come in and renovate 80 to 90 of the units and increase the rent by $200, it's gonna bring great returns for you. So so we want to leave enough meat on the bone for this asset for our next for the next buyer. What does the IRR look like for full renovation plan of all 144 units versus 52 units? That's a good question, Han. I can do that right now live on the call, right? So let's see how that looks like. So let's say if we're doing 100% renovation, and we were doing so our renovation budget increases significantly, but there's the more of a growth in rent. As you can see, the returns are much higher. It's like 22.39%. But again, so it's a difference of about 4 percentage points, and which we believe that we can actually organically do with some of the other cushions that I've showed you on this deal. And the cash on cash too is high. And if we go into the deal and do the initial part, it looks great, and there's opportunity to renovate a little bit more units and get more of the cash flow, we will, right? We make all these evaluations as we go, but consider this as the bare minimum that we're going in and projecting that we'll be able to do on the property. So those are some great questions, by the way. What is the interest rate after 3 years then? So the interest rate after 3 years, it's going to be determined by where the market is at that point in time. So we're saying that we are locking in the interest rate for the next 3 years and locking it at about 5.25. And at that point, we want to exit out to a more permanent loan, or to, if we're going to be extending the bridge debt, then we'll look into that point to buying an additional interest rate cap on the bridge debt going forward. And do you have a neighborhood scout ref to crime in the crime etc.? Yes, we do, Joe. I reviewed it. So this property about a mile away, there's been some crime about a mile away from this property. That's one of the reasons why we have the security camera system that we're going to be putting into the property to make it more secure and improving the fencing and securing that area. So about a mile away, there's been some crime. In this property, in the immediate vicinity of this property, there hasn't been any crime. I don't remember what the neighborhood scout crime number is, but I could look it up and then get it back to you, Joe. Is cost seg being done on this property? Absolutely. We just had our cost segregation study, the initial analysis done. I've sent it to our accountant to kind of project how that translates to investors. And in the weeks ahead, we should have those numbers out and we'll be sharing with you guys. What is the comparison of the projected price per unit for exit sale in comparison to current sales? That's a good question. So Willow Lakes sold, I believe it was for like $138,000 per unit. There are other properties that sold earlier on this year for about 152,000 per unit, right? So our exit, I'm just gonna show you guys so it's not me talking. And I do understand that earlier on in the year, some of the properties were much more expensive. There was more of an increased demand. So our exit price is at about 31,468, which is equals to at about 218 per door. What analysis took place when you determined that? Oh, I think we already talked about that. Investors also send K1 and can participate in the tax benefits of owning the real estate and further boosting their returns. Absolutely, that is correct. Every investor is entitled to the depreciation that comes from the assets as well. How are all these numbers verified? So Javier, the numbers, I'm not sure what specific numbers you're referring to, but all of these numbers are numbers that we got from the asset itself. We actually have like a T12 rent roll that we got to make our projections from, and we looked at everything else, the comps that are in the market. We looked at all the data sources that are shared with you. You can see this is like the trailing 12, the actual performance of the asset right now. This is the rent roll that shows the actual rents that the property is getting, that is being charged on the property right now as of August, and what the most recent rents are being charged for. So this is the starting point of the numbers. Then we take these numbers and we extrapolate it and compare it to what is available in the market. And that is how we come up with some of these projections. As far as our debt and some of the other numbers, the debt is like a hard quote that we get from the lender, and that's what we're presenting to you. And the rent growth, again, I showed you some of the data sources that we get that from. RealPage is a good one. And then we also go into the market and actually visit these properties and get some of that raw data, and that's how we're able to make these projections. Seems like a great deal. Was this marketed with the broker? No, Ali. This was sold off market. Like, it's a testament to the work of our amazing partner, Mr. Tenny Tolofari, and the relationship that he's built with some of the brokers in this market. Tenny went down to Atlanta, and we found out that this seller, somebody that we've transacted with in the past, had an asset that he was considering, and we jumped on it really fast. And we've reviewed this is not the only asset from him that we've reviewed before taking on the contract since we closed on the view. we've reviewed a ton of his assets, and like I said, he has a reputation of just buying and not doing anything and just waiting for the market to come, and then he captures the appreciation and sell. But this one, we looked at it and everything checked out, so we are very happy that we're able to get this. How were you able to convince the seller to sell such a great property? So, so the way Patrick, the way multifamily works is most owners hold these assets for like 3, 5 to 7 years, and once they're able to capture the growth that they have in that property, they're selling it, which is exactly what we're doing, and that answers some of the questions about us renovating only 52 units, right? Because it's like you make your profit and then you pass it over to the next owner. He is coming out of this deal doing really well. He bought this property at $76,000 per unit. I think it was about 4 or 5 years ago. So he is selling it now for 124 per unit. So the market has changed significantly since he bought it. Because of the increased rents, the valuation of the property has increased significantly because of a lot of the changes that happened over the last 2 years with COVID and the economy, and the increase in income and some of the changes that's happening in this area. He is primed to do very well as an owner and exiting. So, and it's our turn to come in and take the property, improve it as well, make it a better community, attract more high quality tenants, then and pass it over to somebody else that is going to use it to grow their wealth as well.
Yeah, an example is the deal that we bought from him, the view at St. Andrews, that we bought at 12.55 million, held it for 20 months, and now we're exiting. So basically going to do the same thing here as well.
So any other questions, guys? Again, I love the engagement. I love the questions. These are some really great questions. Like I said, challenge our assumptions, do some research on your own, go back and do some background research on this property as well. And don't hesitate to come back to us if you have any more questions. I think it's a couple of weeks ago, you mentioned on the YouTube video that demonstrates you extrapolate rent roll into your worksheets. Was that the same? What is the name of that video? Oh, it's from the underwriting class, Teresa. It's a process. It's a class that Manny taught on how to sort data, to kind of sort data out of your rent roll into your underwriting template. I'm going to see if Braden can find that video and send it to you. What is the typical operating expense ratio for this submarket? The 60% expense ratio seems high, but I'm not familiar with this submarket. That's correct, Hon. The expense ratio that we are using to underwrite, it's actually high, and I'm going to show you what it's right here. Let me go back to sharing. So you can see, like I said, RealPage is a great data source that kind of pulls data from all the other apartment properties in the area and kind of evaluates based off of that. And you can see the expense ratio for property this type is expected to be around 46%. So we are at 60%, which is high. As we increase the income, that number is going to decrease. But I'm very confident that we're going to be able to bring that number down significantly as well as we manage the asset. How much longer will this day stay open for subscription? It's going to stay open for until it gets filled out. As of right now, we are 64% subscribed on the deal. So if you are interested in investing, get your funds in, get into our portal, sign your documents as soon as possible and get your funds in. We've seen an increased interest in people that want to invest in this asset. We've actually had to make some capital changes on how we allocate capital just so we could open up more spaces for our investors. We do have some partners that have very, very interested investors that want to jump in and take over some of the equity position on this asset. So if you are interested, if you have any other questions, if there's any other thing that we could clarify for you, please reach out, talk to any one of us, myself, my partners, Julius or Tenny, or our amazing investor relations associate, Braden. we'll be able to help you through that process and get you signed up for the deal. So feel free to have any questions, whatever, take this to your financial advisor or wherever you want to talk to make sure that this is the right fit for your portfolio, and then jump in. It's gonna be a great deal. We had a few people come with us during due diligence and visited the property themselves. And when you go into the property and you see a lot of the things that I'm sharing with you right here, you are very confident about the opportunity. So we love this one. So we'll probably wrap it up. I'm thinking by the 15th or the 20th of this month, it should be filled up. So if you're interested, go ahead and subscribe. Tenny, you were going to say something?
15th or 20th of October.
Yeah, of October. October, sorry, not this month. Yeah.
Yeah. And I just wanted to add in there real quick that this is for accredited investors. I'm not sure if Leslie mentioned it when he did his introduction. So please just take note of that while you go through the process. We've also contracted a third-party accreditation company that XSITE Capital is going to be funding for the accreditation. So you can either use that resource for free, or you can go to your CPA or your accountant to send you a letter to show your accreditation status, and then you'll be good to go.
And so again, if you have any questions, please don't hesitate to reach out. If you or anyone you know might benefit from being part of this asset, jump on board, and we'll look forward to being of great value to you and helping you grow your wealth as well. And I thank you for your attention and for giving us the opportunity. And we look forward to providing value to you. And if we don't have any other questions, I'm going to wrap it up. And
yes, we're going to share the video. If you want to, if you need access to the video, just let us know, and we can definitely share the video to you and everybody that needs it. Okay. Thank you all so much for joining. Great job, Leslie.
Great job, Leslie. Everybody, round of applause for Leslie.
thanks, guys.
For all applauding.
All right.
Thank you, everybody.
Good night, everyone.